Okay, guys. So, welcome to the session. We are just going to start off with the financial management session. The agenda of the session is that we are going to be doing the revision of the financial management. And I believe the best revision is when you do the revision using the question-based approach. So I'll be using a question-based approach to revise the financial management syllabus. The way I'm going to go about is that I will be doing the investment appraisal first, and then I'll be doing the other areas because my major objective is to handle the section C questions. So I'll be doing the section C questions, and I'll be taking you people through the section C scenarios. So basically, let's just begin. Let's just start off. What I'm going to do is that I am going to start sharing my screen. And what I'm going to start sharing is I will start sharing the ACCA CBE practice platform. So I have got the ACCA CBE practice platform, which I've just logged in. So in addition to the ACCA CBE practice platform, I will also be opening up the spreadsheet, which is the Excel. The reason being that if I do the answers on the ACCA CBE practice platform, then I cannot share, even if I share the answers with you, they will be in the form of PDF. They won't be showing you the Excel formulas. So what I'll just try to do is that I'll try to share the Excel formulas with you. So the first paper that I'm going to start off discussing with you people is from the December 2024 examination. So the FM December 2024 examination, that's the first question that I'm going to share with you. And I'm going to start discussing that first question with you. So Um, this specific paper is on the ACCA CB practice platform. I'm going to go about discussing this specific question and see how things go about. Okay. So basically, this is FM September, December 2000 and September, December 2024 examination. What is it? It is FM September, December 2024 examination. Now let's just talk, let's just discuss. The requirements of this question is that for the GPE project, calculate the expected net present value. That's one thing. The second thing that the examiner is asking is that comment on its financial acceptability. So if you look at this specific question, the 10 mark is for the expected net present value and 2 marks are for the financial acceptability. Now, let's discuss that is the what exactly are we gonna do? How exactly are we gonna calculate? As I said that I'll be doing the majority questions on the Excel. The reason being that I can share the Excel with you, but if I do it on the ACCA CB practice platform, it gets exported in the PDF format and that becomes difficult to share that. Now let's just begin. Let's talk about it. So first of all, it says expected net present value. So whenever we talk about the net present value is something that you know. It's simply you add up the sum of the present value of inflows and outflows. So you add up the sum of present values of inflows and the outflows, so you get the net present value. When we talk about the expected net present value, the word expected net present value actually refers to what? So the expected NPV is what? The expected value is based on probability scenarios. So the expected value is based on probabilities. I mean, the expected values is based on probabilities. Now, when we talk about the expected values, so what exactly do we do with respect to expected values? So let's say if I'm getting NPV 100, 250, 190, etc., etc. And there's a 30% likelihood, let's say there is a 50% likelihood, there is a 20% likelihood. So hence resultingly what happens is that when we talk about the expected NPV, the expected NPV is going to be what? Expected NPV is going to be, let's say this is 100 times 30%, 250 times 50%, then there is this 190 times 20%. So if you add up, if you sum up all of these, the sum of all of these is going to be what? Sum of all of these is going to be 193. The sum of all of these is going to be 193, right? Sum of all of this is going to be 193. Now, what have we done? We have applied the probability calculations to it, and we have got an expected value that's called expected net present value. Now, so let's just move a bit forward and let's just try to do this specific question. I'm going to give you 3-4 minutes to read through this question. I could just zoom in the screen with you people also if you want, so that you could just see it. In fact, if I zoom in, then it's not completely visible. So I've just zoomed out. So can you just go through this, try to calculate the expected net present value? Yeah, can you just go through it, try to calculate the expected net present value from it? Okay, let me know if you people have gone through it. Okay, let me just begin. Okay, let's begin. So basically, if we talk about this specific case, it says that Gall Company is a company which manufactures car batteries. Its latest project is a new battery called the GPE. Now, which is a variation on an existing battery but uses less harmful materials in its construction. Due to technological advances, the GPE project is expected to have a life of only 4 years, right? So what is it? It's going to be 4 years only. So the life of this GPE project is going to be 4 years. Now what next is there? Sales for the first year are expected to be 10,000 units, but the remaining 3 years are more uncertain due to risk of similar products being launched by competitors. So first year sales are going to be 10,000 units. Now, what next is there? Are more uncertain due to similar products being launched by competitors. Gall expect that sales volume will remain constant at 10,000 per units for the final year, but there is a 30% probability that the volume could drop to 5,000 units per year for year 2, 3, and 4. Now, what's the probability? It's like 30% probability that it's gonna be 5,000 units. The GP has a selling price in current price terms of 70 per unit. So selling price is $70. When he says in current price terms, so current price terms means that inflation is to be incorporated from now. The inflation is to be incorporated, but sales price inflation is expected to be 4.5% per year. So the variable cost is 45 in current price term. Variable cost is $45 from current price terms, but variable cost inflation is expected to be 3% per year. Okay, current price terms. Then what happens is the variable fixed cost will remain constant at 10,000 per year. I'm just taking a note for myself so that it doesn't become a difficult thing. The manufacturing equipment costing 500,000 will be purchased at the start of the first year of production. Cost of equipment is 500,000. The equipment will qualify for tax allowable depreciation at 25% on a reducing balance basis. Now, and it is anticipated equipment will have a zero residual value at the end of 4 years. Working capital of 80,000 will be required. Working capital of 80,000 will be required at the start of first year of production, and working capital inflation is expected to be 3%. Working capital is gonna be $80,000. $80,000. $80,000. Working capital needs to be in place at the start of the year to which it relates. It will be released at the end of the project. The tax rate is 20%, and tax is paid at the end of the year to which it relates. Goal is profitable and can use unutilized tax allowable depreciation. Okay. Tax rate is 30%. Okay. WACC is 13%. Now, let's discuss about it. Okay, now let's just begin. So how exactly are we gonna do 0, 1, 2, 3, 4? Now starting from this, we would actually say selling price. We would say variable cost. We would say selling price. We would say variable cost. Now when I talk about the selling price, see, the selling price is $70, and this $70 selling price, it has to be inflated. By how much? By 4.5%. So I'm actually gonna do it, multiply 1.045. Right? And what we are going to do is that we're going to multiply this by 4.5% every year. So this is how the selling price is going to increase. Then we have got a variable cost that is subject to inflation, which is 3%. And we are actually going to increase it by 3% every year. So this is how it is actually going to be. So we get the contribution per unit. So what do we get? We get the contribution per unit. We get the contribution per unit. This is this plus this. Now, when we talk about the contribution per unit, so you have got the number of units also. The number of units are going to be what? The number of units are going to be, let's say, okay, now what I'm going to do is that I need to actually do some working for the number of units. So for the time period 1, it's 10,000. That's okay. And then what happens is that for time period 2, 3, and 4, time period 2 till 4. So what is actually going to happen is that it is a 30% chance that it will be, no, 70% chance that it will be this. 5,000 units, it will be 30% chance. So resultingly, what happens is this is what it is going to be, this and this. So hence resultingly, what happens is if we add up both of them, 8,500, right? So year 2 till 4, it is going to be 8,500. So year 1 is going to be 10,000 units. Year 2, it's going to be 8,500 units. So hence resultingly this and this and this and this. Right now, what do we have? We have a fixed cost over here, right? So when we have a fixed cost over here, how much is the fixed cost going to be? The fixed cost is going to be like this. The fixed cost is going to be, we have a fixed cost of 10,000 and it doesn't change. Is there an inflation mentioned about the fixed cost? It will remain constant. So when it is going to remain constant, this is what it is going to be, right? This is what the fixed cost is going to be. Now, when we have a fixed cost, then the next thing what we have to do is that there are two ways of handling it. There are two ways of handling it. Now, what are we going to do with respect to it? Let's try understanding. Now, what we are going to do with respect to the depreciation is we're going to do it like this. Depreciation. Now, it says here, depreciation, the tax savings on depreciation. Now, so what you could do is that you could say the profit before tax is this plus this. The taxation at the rate of 20%. So taxation is going to be 20%. Then what happens is that if I say 1, 2, 3, and 4, so the asset is going to cost me 500,000 and will have a 25% reducing balance depreciation. So the tax savings on depreciation is going to be this into 20%, right? Now, so what actually happens is that the tax savings on depreciation is going to be 25,000, is going to be 18,000, is going to be 25,000, is going to be 18,750, is going to be 14,062.5, is going to be this, right? So tax savings on the depreciation. Tax savings on the depreciation is this. So tax savings on depreciation, and then we have got the investment. The investment is going to be negative 500,000. And the residual value is going to be 0. Working capital. Working capital is going to be 80,000. So if I talk about the working capital calculation, here working capital incremental. Here 1, 2, 3, 4, right? So the working capital is going to be 80,000 here. And then this working capital is going to increase by 3%, right? So the incremental is going to be this. Incremental is going to be this minus this. So resultingly, we have this. Now, if we talk about it, the net present value is going to be how much? The net present value is going to be equals to NPV bracket open, the rate. The discount rate is 13%, comma. You select all these values and then you add up this. So 140, 640, 140, 640, 140, 640. Okay, the NPV function is going to be used. How? It's like NPV. How do we do it? We do it like this. We say equals NPV, bracket open, the rate that we are going to be using, 13%, comma, select all the values here, these values, bracket close, and then you add up the outflow. Then you add up the outflow. So resultingly, it's going to be 140, 640. It's going to be 140, 640. Okay. I'll just demonstrate this NPV calculation to you on the ACCA spreadsheet function also, so that you could see that how does it operate on the ACCA spreadsheet. Okay, I'll just show you how. I'm just gonna zooming it into 200%. Let's say this is time period 0, 1, 2, 3, and 4. Now assume that the cash flows that we have is, we have what? Minus 580,000. Then we have 229,000. Then we have 203,447. Then we have 212,337. Then we have 344,389,839. So this is what we have, right? Now, once we have these, what are we gonna do? We're gonna say okay to all of these. We're gonna say equals the NPV function is gonna be like this, equals NPV bracket open. Now you select all the values and you say comma 13%, and then you add up this amount. So you get the NPV. You get the NPV. If I could just make it like this, so it's actually gonna become, oh, okay, just a second. I think probably I've missed out something. I'll just click on the help formula sheet. So if I click on the help, so spreadsheet formula, it is actually gonna give me the NPV formula that is to be used on this function. It says NPV, comma rate. Rate is required. So I'm just gonna do it like this. I just made a bit of an error over here. NPV 13%. No, I'll just write it down 0.13, comma. And then I'm gonna just say, okay. See, yeah, I got this 146.40. So all that I have to do is that I'll just open it up. What did I do? I said NPV bracket open. Whatever the interest rate is, I just wrote it down as 0.13, the 13%. And then comma, what did I do? I selected all the inflows. Right? All good? All good, yeah? Yeah, let me know all good. Yeah, all good. Okay, great. So we had this, that expected net present value. Now it says comment on its financial acceptability. So what are we going to do? We're going to say that, okay, let's see. Since the project has a positive net present value, therefore it is financially feasible. Therefore, it is financially feasible. So since the project has a positive net present value, therefore financially it is feasible. Therefore, it is financially feasible, right? All good? Okay, let's move a bit forward. So what is the next part of this question? The next part of this question is discuss the four techniques for dealing with. Discuss the four techniques for dealing with risk and uncertainty. So we have to talk about the four techniques that are used for dealing with the risk and uncertainty. That's what we have to do. Now let's talk. Let's discuss about this. That what are the different techniques that are used for the risk and uncertainty. So what are the techniques that are used for the incorporation of risk and uncertainty in the decision making? Do you know what techniques we can use? Yeah, any idea what techniques do you think we can use? Okay, so I'm just going to write down few of the techniques that we could use. Number one of them is sensitivity analysis. Number two is basically risk adjusted back. The third one of them is basically simulation analysis. Fourth one of them is adjusted payback. So fourth one of them is adjusted payback. So there are few techniques that are actually being used. Now, what exactly these techniques are? Another one of them is the expected value technique. So sensitivity analysis is basically what? It's one of those techniques, a technique where all other things are kept constant and only one variable is changed, and the changed such that NPV becomes zero. The variable in which smallest change, smallest percentage change leads to highest reduction in the NPV is considered to be the most sensitive variable. Is considered to be the most sensitive variable. Then we talk about the risk adjusted WACC. Then we talk about risk adjusted WACC. So when I talk about the risk adjusted WACC, what exactly are the risk adjusted WACC? Let's try understanding this. So when I talk about the risk adjusted WACC, the concept of risk adjusted WACC is that the risk adjusted WACC is you you adjust the, which is basically incorporate the risk relating to the, incorporate the risk relating to the business and the financial elements in the beta calculation, and the risk adjusted beta is used for the estimation of the cost of equity. Now, when we talk about the simulation analysis, what exactly do you mean by simulation analysis? So what actually happens is that it's similar to sensitivity analysis, except that multiple variables change at a time and the impact on the net present value is assessed. The longer period projects are being adjusted to ensure that the uncertainty in the cash flows beyond a certain time period is reduced. And lastly, expected value incorporation of the probability in all the possible outcomes. So that's what you do. That's what you do with respect to the expected value technique. That's what you do with respect to expected value technique. Right? All good. So that is basically all about this specific question. That was Gall company relating to September, December 2024. So it was Gall company related to September, December 2024. Gall company, September, December 2024. Now, let's move a bit forward. So I've gone through this. Now I'll just move on. I'll just move on and I'll try doing another question. Let me just go about it. So, okay. So what did we do? We did September, December 2024. It was September, December 2024, the Gall company. Now let's just begin. We are now going to talk about September, December 2023. So we're going to try and do another examination and see that how things go about. Okay. Now this is one of the question from the September, December 2023. This is one of the question from September, December 2023. And what is this question all about? Let's try understanding this. So September, December 2023 is like this. It says Polorov company produces household electrical goods for its home country and so and so, so and so things are there. It says difference between the risk and uncertainty. That's one question. What's the second question? It says calculate the nominal net present value. When the examiner says calculate the nominal net present value, the nominal net present value actually means that he's asking you to calculate inflation adjusted. He's asking you to calculate inflation adjusted. So I'm just going to do it here. Okay. So basically, there's something it says calculate the nominal net present value of the investment project and comment on its financial acceptability, calculate sensitivity of the project, so and so, so and so. So what do we have to do? We have to calculate the nominal NPV. I'm just gonna make it a visible one. So, okay. Can you just go through this question for 5 minutes and then we could just start off? Okay, let's begin. So it says Poloro company produces household electrical goods for its home country, market and for markets in neighboring countries. Poloro is planning to make major investment in new production facilities in order to produce an upgraded model of its cooker. Poloro's finance director has assigned the probabilities of a number of possible sales volume of this new model based on Poloro's previous experience of launching product upgrades. He has calculated annual expected values for the sales for the 4-year time period over which the investment will be assessed. However, after a number of years of a strong economic growth, Poloro's home country and its neighbor appear likely to enter a period of recession, meaning that consumers may be less willing to spend money on the new kitchen goods. The initial investment cost will be $39 million. The finance director has assumed that there will be zero realizable value at the end of the 4 years. The working capital can be ignored. The expected volume of sales are as follows here: 1, 2, 3, 4, 60,000, 150,000, 80,000. Expected contribution from the upgraded cooker throughout the year is 200 per cooker. This will not be affected by the rate of inflation. Incremental fixed costs excluding depreciation are expected to be this much in year 1. They will increase by the rate of inflation in each of the year 2 to 4, which are predicted to be as follows. The tax rate is 25% per year, 1 year in arrear. So the tax will be paid 1 year in arrear. No tax allowable depreciation is available on the investment expenditure. Poloro's tax rate is 11%. One of the other directors commented he thinks the level of contribution finance director assumed is too high. He also wondered so and so, so and so. Okay, we're going to talk about it a bit later. Let's just talk. It says calculate the nominal NPV of the investment project. So if I talk about the calculation of the nominal NPV, B1, it's time period 0, 1, 2, 3, and 4. Now what next is there? There is actually going to be what? Contribution per unit. Contribution per unit. So when we talk about contribution per unit, we have 200, right? We have 200. Now the number of units is going to be what? 60,000, 150,000, 140,000, 80,000. So the total contribution in terms of millions is going to be, I'm just going to convert this into million, this into this, divided by 1 into 10 raised to power 6. So 10 raised to power 6 makes it a million. 10 raised to power 6 makes it a million. So I've just converted this into millions. Then what actually happens is that fixed costs. So when I talk about the fixed costs are going to be 2.5 million. Fixed costs are going to be this into 1.06. This into 1.04. This into 1.03. Fixed costs And then what happens is there is no depreciation, right? So profit before tax. Profit before tax is this plus this. And then the tax expense at the rate of 25% is going to be like this. This into 25%. So what is actually going to happen is that there is actually going to be this. Now we have got investment. What's the investment value? The investment is what? 39 million, right? So hence resultingly, what happens is this is what we have got. Cash flows. The net present value is going to be what? The net present value is going to be like this. The net present value is going to be like this. Uh, we have a discount rate of 11% equals to NPV bracket open 11% comma this and then plus this. So hence resultingly, this is what it is going to be. 5.85 million is the NPV. 5.85 million is the NPV, right? Okay. So we have discussed this. Okay. So let's just move a bit forward and let's take things forward. So we have talked about how the NPV is going to be calculated. Now, next is it says comment on its financial acceptability. So what are you going to do? You're going to say that since the project has a positive NPV, although there is uncertainty relating to the units that could be sold, the project is financially acceptable. Now what next is there? Let's move a bit forward. Let's discuss further. The next situation is um, it says calculate the sensitivity of the project's NPV to a change in the level of contribution per unit. So when we talk about sensitivity of the change to the contribution per unit, let's talk B2. So when I talk about the sensitivity of the change to the contribution per unit, what exactly is it going to be? Let's try and understand this. So the formula for the sensitivity calculation is NPV divided by present value of cash flows. It's NPV divided by present value of cash. So I need to calculate the present value of cash flows for the contribution. How am I going to do that? I'm going to say, okay, these are the contributions that we have. Let's talk about this time period 1, 2, 3, and 4. Discount factor, present value. So the present value of cash flows will be this, Now, so if I talk about the sensitivity, it's going to be NPV divided by this. It's going to be NPV divided by this. So 8.84%, 8.84%. 8.84%, right? What is it? It is 8.84%. So that means if there is a 8.84% reduction in the contribution per unit, the NPV is going to become negative. The NPV is going to become negative. So if there is a 8.84% change, then the NPV is going to become negative. Okay, what next is there? Calculate sensitivity of the project's NPV to a change in the discount rate. So discount rate sensitivity to be determined using IRR. So I would say IRR equals to the IRR is actually 18%. What is it? It's 18.4%. So how do we calculate the sensitivity? The sensitivity is going to be like this. It's going to be 18.4% minus 11% divided by 11%. So the sensitivity to the discount rate is going to be 67.28%. So that means if the discount rate increased by 67.28%, this is going to become a negative NPV project. This is going to become a negative NPV project. Okay, let's move a bit forward and let's discuss further. So then it says compare and contrast sensitivity analysis and probability analysis as a method of assisting investment decision when there is more than one possible outcome. So what do we have to do? We have to talk about the sensitivity analysis. We have to talk about the probability analysis in case if there is more than one possible outcome. In case if there is more than one possible outcome. So if I could just go about discussing this comparison of sensitivity with probability analysis. So what is actually going to happen is that comparison of sensitivity analysis with probability analysis. What is actually going to happen is that you would actually say that if we compare both of these, how things are going to be, let's see. Sensitivity assesses one variable at a time, whereas probability analysis considers, whereas the probability analysis considers so sensitivity assesses one variable at a time, whereas this probability analysis considers multiple variables simultaneously. That's what it does, right? Now, what next is there? The next situation is sensitivity does not provide a definite result, whereas probability does recommend a result. expected value, probability analysis provides diverse results, whereas sensitivity provides a specific result. So that's where the difference lies between the sensitivity analysis and the probability analysis. That's how things are. So we are done with this specific question also, which is Pilo Rough Company.